Hi, everybody. Thank you for joining us today for the second quarter of the Feldmeyer Forecast. You are joined today with Alyssa and Ben to go through a couple of updates. There's been a handful of things that have happened over the last quarter, to say the least, and some outlook has changed for the rest of the year a little bit with all the developments that we've had. So we'll jump right in on things and get us going. Today, we are going to cover a handful of topics. We'll take a look at just a quick overview in terms of the last quarter, some of the big news that we saw there. Obviously, we've seen a change in oil prices at the pump, and that's impacting the economy. So we'll have a little bit of a discussion about that. Where are we today with interest rates and inflation? And then also diving a little bit into the private markets, some of which has been making more headlines than others the last couple of days. Last couple of weeks in terms of the private credit market. But we're also going to talk about private equity and private infrastructure and some of the changes that you're going to see in the models going forward for the rest of this quarter. So kicking things off, taking a look at the first quarter headline recap on things. Handful of things for us to go through and review. First and foremost, beginning of the year, Bulgaria joins the Eurozone, replacing their currency with euros. U.S. captures Venezuelan President Nicolas Maduro and his wife. The Indiana Hoosiers win their first ever college football national title. The U.S. exits the World Health Organization. Late January, we had massive winter storms hit over 30 states, killing at least 85 people in one of the most widespread and deadly winter events in recent years. Glad we're moving into spring. Late January, the tariff costs did start to hit consumers. Businesses that had absorbed roughly 80% of the tariff costs in 25 began passing them on to shoppers and businesses. Specifically, grocers, appliances, and electronics saw early price increases when their pre-tariff inventory had officially run out. Beginning of February, the Federal Reserve held rates steady. We also saw the Milan Cortina Winter Olympics that took place. The U.S. brought home 12 gold medals, 12 silver, and 9 bronze, making a new medal record for the U.S. Super Bowl 60 this year featured the Seattle Seahawks defeating the New England Patriots. End of February, we saw the U.S. and Israel attack on Iran, killing their supreme leader. That led to the Strait of Hormuz closures that rattled our oil markets. The U.S. and India reached an interim trade deal for reciprocal tariffs moving from 50% to 18%. At the Oscars, one battle after another won the Best Picture award. End of March, we saw Federal Reserve hold rates steady again, noting that the Iran conflict added additional uncertainty into the marketplace. And not necessarily in the first quarter, but definitely the beginning of this one, headline news. Saw the Bureau of Labor Statistics announce that headline inflation rose from 3.3% up sharply from 2.4% in February. So quite a bit in terms of what we saw this year. Specifically, we saw a big change in the market over the course of the quarter.
So we've used this slide before. The reminder here is just every year when you look at something, an index like the S&P 500, every year going back many decades, there is no year where the market starts up and just goes up and stays up all year. There's always something, right? Last couple of years, it's been COVID, it's been the value of the dollar, it's been tariffs, it's been whatever the case might be, something that you can put your hand back on it and say, yeah, that's right, things did do that, right? Average drop, as we've highlighted here, around 14% during the year. But we've had a positive rate of return 35 out of 46 years, which is, if you're a betting person, that's a pretty good bet. You just have to be willing to ride out the volatility. And we're expecting to see a fair amount of volatility this year.
Mm-hmm. And these numbers are as of the end of the quarter, so end of March. By the time we're recording this, it is April 13th. And we've seen a fair amount of recovery even just in the first 2 weeks of the quarter as well. We also have to touch on oil markets and the change that we've seen at the pump. Taking a look at a couple of metrics here on the top left-hand corner, we see production of oil. We also see consumption in terms of looking at things from a overarching standpoint, what we'll notice is that over the last couple of years and then forecasting into 2027, we've seen an increase in production, also an increase in consumption, but not quite at the same rate. So we look at this to say there is plenty of supply that is available globally, and as well at home, and we will continue to see an increase in consumption. The price at the pump is going to be relative to a supply and demand issue at the moment in terms of being able to get oil where it needs to go. One other thing to consider, there has been a fair amount of discussion in the news and questions that we have started to get in terms of saying if oil prices stay high for longer, does that put us at risk for recession? And if you notice over on the right-hand side where we look at oil prices as of the end of March, we're hovering just above $100 a barrel in terms of oil prices. Having spoken to a number of our partners and asking the same question to get their feedback from their economists, the resounding answer that we've gotten is that for oil specifically to push us into recessionary territory, we would need to be pushing closer to $140, $150 a barrel, which you can see the last time that happened was back in 2008, before we look at saying this is really something that this single factor alone could push us into recessionary territory. So quite a ways to go before that would be something that we would consider as a risk.
Here we take a look at gas prices on the left-hand side. This is color-coded by year. 2022, 2023, 2024, etc. The red, or rather orange line that doesn't continue forward, it just rises and then stops. That's this year. So what we've seen is rising gasoline prices, of course, tied to the instability of the supply side of the supply and demand that we just looked at. We've got plenty of capacity. The aspect of drill, baby, drill, we need more and more rigs and more everything else and stuff. We're really on a good path. It's getting it to market is the problem at this stage of the game. The increase in prices, if we look at the bottom right-hand corner, what we see down here is very believable. And that is that the more money you make, the less the impact of the cost of energy is to you. But for the lower side of the socioeconomic spectrum, it does take a bigger percentage of their income. And you can see for the folks down at the very bottom of the socioeconomic spectrum, it's over 15% of their income, right? So this is an issue, and it will have an impact on slowing down some spending in the economy.
Coupled with taking a look at electricity cost rising. If you have taken a look at your electric bill for the last couple of months and last couple of quarters, most of us have noticed an increase in terms of your cost of electricity. And that can be due to a number of different factors, but we're also seeing continued need in the US as a whole because of all of the different infrastructure that's being built, the data centers, all sorts of new manufacturing and things that we're looking at bringing back to the United States will also get added to the power grid. And so we will probably continue to see an increase in electricity demand as well.
And if we can't keep up with it, the price is going to rise. It just is.
Switching gears a little bit and taking a look at the Federal Reserve chair. Jerome Powell's term is up this quarter, and so it opens the door for a new nominee to be put into place. We have talked about this a little bit last year in terms of forecasts for economic outlook this year. And fair amount of information here. We actually were able to pull some of this information from the political analyst who's going to be coming out to visit us and doing a dinner for clients here in September, taking a look at some of the geopolitical changes that are going on and more in-depth analysis on some things. Pulled this out of his most recent update. It is most likely that either Powell does not step down immediately, or even if he's still there, his influence on the board with the amount of people that are still there and follow a very similar thought process to him, it will be difficult for Kevin Warsh to be able to come in and be able to just make sweeping changes. And keep in mind, it is still a board and it is still a vote. And although he may be the chair and the spokesperson for the board, it does not mean that he can railroad everybody. He may be able to be persuasive, but it is relatively unlikely that he'll be able to make sweeping changes to lower interest rates where the administration had wanted them when we have inflation that's creeping up due to the conflict.
So generally, the economy slows down, interest rates are reduced to speed it up. The economy's fine. We're inflationary because of the tariffs and energy and other things. If prices are going up, if the economy starts to slip into a recession because of the increased costs on things, leading to reduced buying power elsewhere, cutting interest rates to put more money back into the economy is simply going to throw gasoline onto the fire of inflation. So we'll see.
Shifting gears a little bit from general economic outlook to look at investments more specifically. We've started talking about this the end of or last quarter. And as we discuss continued interest in the private market space, one of the biggest things that we have been communicating to clients is the understanding that the public market is actually a very small portion of major revenue generating companies out there. A huge portion of those profitable companies are private companies. And there has not historically been a great way for the average investor to be able to capitalize on anything going on in the private space. That has changed in terms of access to those investments. And we have been working pretty diligently with different fund companies and different investors in the private space to find the right partner for us, and have added to the private equity allocation within the models and the stock model and the alternatives model, because we see a big benefit here in terms of a portion of the market that you're not getting if we're solely invested in the public market itself.
The opportunity within this space is also found in infrastructure. On the left-hand side, at the bottom of the chart, we see water and roads and power and transit. We're just talking about power, airports. These are things that are infrastructure build-outs. The darker part of each bar chart indicates planned funding. The lighter part above it is that the additional that's needed to get us where we need to be over the next decade or so. So we see a ton of opportunity available here, not only globally, as we see on the right-hand side, but the United States, absolutely.
To put a little bit finer point on it, taking a look at the actual need that's out there, the total infrastructure investment gap in the United States alone is over $2 trillion. The last couple of years, we've seen a fair amount of capital raised in the private markets for infrastructure related projects, but you can see that number in billions is nowhere near what's needed in $1 trillion estimate. And then we look at not just the US, but globally, looking at 9.2 trillion needed on an average global investment every year to achieve the energy goals that have been put forth. There's a pretty massive opportunity there. And we have added in an infrastructure investment in the alternatives category as well to capitalize on some of this. And as a quick reminder, one of the talking points we had discussed last quarter was the volatility metrics of the private investments versus the public investments. Compared to a 60-40 portfolio, infrastructure had almost a 0% correlation. And And going forward, we expect that those metrics will likely be similar in terms of easing some of the volatility that we're seeing in the public market with being able to implement private investments as well.
The growth in the private markets, there's private equity, that's ownership, there's the infrastructure we just talked about, and then there's also the private debt. This is where companies are borrowing money because they're growing very fast. And on the top right-hand corner up here, what we see is in gray, I said gray, is that gray?
That's great.
We see how much the tech sector as a percentage of the total private credit market is in gray. Okay. And that's as of 06. And 20 years later, we see the numbers in blue, which what we see is over the last 2 decades, that there has been a substantial increase in the amount of private debt in all sorts of different forms, high quality, high yield, the leverage loans. The takeaway on this is that the tech sector is growing so fast that they're borrowing a lot of money. That is where the concern has been within the private credit market is, has there been too much money loaned to the tech sector? And as AI continues to advance and some of these tech companies that are growing real fast don't make it and aren't able to pay their debts, are the investors going to get caught up in this? And the answer is, if you were in the right places, probably not. If you were in the wrong places, you could have too much exposure on it. So our role is to keep a real close eye on all of this stuff relative to where money is actually invested and the specifics on it.
And to ensure that any sort of credit investments are still top quality investments, which we have done. Taking a look at just a recap in terms of where we sit right now. We read through all of the news headlines that were big headlines from the first quarter, and there's a big array of things that went on in there. Even as we started compiling it as a team, kind of forgot that the Olympics even happened. It feels like it was a lot longer ago than just 2 months ago. Taking a look at the way that we have shifted globally in terms of the way that we conduct business and the essential partnerships that we have out there, a lot of things have changed. When we look at changes to demographics on the population shifting over time, when we look at geopolitical issues, Russia really kicked that off with their invasion of Ukraine. Now we have other conflicts, and we've seen other things that have transpired since then. We've also seen a change in need for critical minerals coming from other parts of the world to be able to build all of these reactors and to be able to build all of the chips and to be able to build all the things that we need to be able to run these data centers and AI. There's a lot that is continuing to transpire and a lot that will continue to change over the course of the rest of this year. And closing thought on things, like it or not, we live in interesting times. There are times of danger and uncertainty, but they're also some of the most creative of any time in the story of mankind. That was true when he said it, and it's still true today. As things continue to evolve and change, we will continue to stay on top of it, continue to make adjustments where appropriate, and keep everybody in the loop as we go.
That's good.
Thank you for joining us, and we'll see you again next quarter.